If you want to become a highly successful forex trader, you need to stop gambling your money away on highly volatile pairs such as gold and learn to trade them the correct way. Here's how you can do that. What's up guys, welcome back to the channel. In today's video, I'm going to be taking you through an easy to follow strategy that works particularly well on gold. I'm going to be going through a trading plan that you guys can implement, and at the end of the video, I'm also going to be going through some examples that I took in the past. So if that sounds interesting to you, make sure to stick around to the end of the video. Make sure to like, subscribe, and let's get straight into the video. Okay guys, so as I mentioned, the first thing we're going to do is go through a trading plan that you can implement in order to trade gold. So the trading plan I'm going to go through includes the strategy or the system that we're going to be trading, which is arguably the most important part. We're going to go through risk management, and we're also going to go through where our targets and stop losses should be. So starting with the actual strategy or system, the first thing we're going to do is identify the overall market structure and also the substructure. So what I mean by this is we're going to be identifying on the higher time frame the main trend. So let's say the trend is bullish on the higher time frame. That is our main structure. And then by substructure, what I mean is the sort of lower time frame trends within these bigger moves. So for instance, if the higher time frame is bullish like this and we do a small correction on the lower time frames, that would be a bearish trend where we can look to take some sell positions if we get a valid entry. So this is what I mean by identifying market structure. I mean also the trend, but as well as the trend, we also want to identify where our POIs are. And for the POIs, what I mean is we need to see an imbalanced area of supply or demand, following the trend and following where the mitigations happen, meaning that we want to see where price is sort of coming into and then moving away from, where the key structure points are. So following this trend, supply and demand areas that must be imbalanced, and we also have to have liquidity above or below those zones. So for example, the main two types of POIs that I currently use, the first one is when we have a higher time frame trend like this. Maybe we have some liquidity like this, and our area of imbalanced supply or demand is this sort of area below the liquidity, in line with the trend. This would be an imbalanced area. We have the liquidity above. So this would meet our entry criteria of what a POI actually is. The second type of POI I use is when we have a higher time frame trend like this, and then we actually observe a break in the trend when we break this current trend low with momentum. And then we pull back into an area of supply and look to sell down, where our POI would be this area just here. And we also require to have some liquidity below it as well. So those are the main two types of POIs that I currently use. Then for number 3, we're looking at lower time frame entry models. And to keep this video very simple, I've included one type of entry model, which I find to be the most effective, and it is also the most common one that I currently use. So simply put, what we want to see is a sweep of liquidity in our higher time frame POI. So this only applies when price is in our zone, otherwise we're not taking a trade. We want to see a sweep of liquidity followed by a change of character. So if you guys don't know what a change of character is, what we're looking for is for price to, let's say price is approaching our area of supply just up here. On the lower time frames, price is in a bullish trend on the approach. Once price taps into that area, we want to see something like this, where we take out that current higher low, close below it, and then price pulls back into an area where we can look to sell down. And the actual change of character, for anyone that doesn't know, is this area here. When we break out of that current uptrend into the downtrend and break this structure in the opposite direction to the trend, If we break structure with the trend, that would be just a break of structure like this. So we also have one just here. So the main difference between a break of structure and a change of character is that the break of structure happens in line with the trend. A change of character is a break in the opposite direction to the trend, if that makes sense. And for our lower time frame entry model, what we want to see is for price to sweep this high into the area of interest, break structure, and then we want to see an area of supply up here, which is imbalanced, and that would be our entry zone. Same thing with a downtrend. So if we have an area of higher time frame demand and price on the lower time frames is approaching it in a bearish trend like this, we want to see price sweep liquidity, break structure, tap back into an area of demand. So we have, if we mark this on, a sweep. Here is our change of character, which is the break of structure in the opposite direction to the trend. We then we identify an area of demand within this range, which is imbalanced, and that will be our entry area. This will become a lot more clear when I go through some examples in a minute, by the way. So if you're a bit lost at the moment, don't worry, it will be further explained later on. Risk management. This part is very simple. We do 1% risk per trade. And that applies no matter how we feel, no matter if we're on a losing streak, a winning streak, only ever 1% risk. No break even except before high impact news such as NFP, simply due to the fact that you can get slipped if you aren't break even. I would also consider maybe just taking profits before the high impact news if your trade is running in profits. And we want a minimum of a 1 to 3 risk to reward, otherwise we're not taking the trade. As for the targets and stop losses, targets, we're targeting areas of liquidity or the next trend high / low within the current higher time frame trend, or any areas where we think price may reverse from. So these can be supply / demand areas where you may see price react from. So basically we're targeting highly reactive areas where we expect price to possibly reverse on us. And the stop loss will just be below the swing high / the swing low, which I will show you guys in a moment. So that is it for the trading plan. If we now get into some examples, and I will show you guys some of the best trades that I've taken on gold. Okay guys, so now I'm going to go through 2 examples of trades that I've taken on gold in the past using this exact strategy. So if we go back to the system, step 1, identify overall market structure and the substructure. So in this case, we have a very clear bearish trend. And if we draw on a few of the mitigations and the breaks of structure, we have price came up, pulled back into this area of supply. We then came back down and took this low. That is our break of structure. And we have left behind an imbalanced area of supply just here. So that would be our higher time frame point of interest where we're looking to get in the trade. And then we simply wait for price to come into our area. Like so. So once price is in our area, like I mentioned before, we want to see the lower time frame entry model, sweep of liquidity, change of character, imbalanced area of supply and demand. Supply or demand, sorry. Let's see if we get that. So a lot of the times what you'll see with this strategy is that when we have these areas of supply or demand, price will initially push away like this, and then it will come up one more time, sweep the people that sold early, and then take out the low, and that is our confirmation. So if we change the color of this and mark it on, we've had a sweep. We then had the change of character, and the area of supply that caused this break in structure was this candle right there, which we can probably go ahead and refine. So the area of supply that took the liquidity was this 5-minute zone here. You can see this candle wicked above the high and then melted back down. And the reason why this strategy works so well is that once liquidity is taken out of the market, price normally comes back and retests the candle or the area of supply / demand that took the liquidity. And if your analysis is correct, you can simply have a stop above the candle that swept liquidity, because in theory price should not break that level, and if price was to break this level, our analysis would be wrong. And then we just target the trend low. As I mentioned, if you're a bit more of a conservative trader, you could also have the stop loss above the area of higher time frame supply, as obviously price could also come up and sweep this level one more time and the trade could still be valid. So if we wait and see what price does, notice how we also start to induce the level with this area of liquidity just below it. Tap into the level and there we go, the TP was hit. And notice how this area is respected and price sort of fails to break above it. It's sort of like a protected area where price can't break. We had 1 rejection, 2 rejection, 3, 4, 5, and then price melts over to the downside. And this happens all of the time when you're using this strategy. So to go through again, higher time frame point of interest, sweep of liquidity, retest of the candle that swept liquidity, and we also need that to see that breaker structure to the downside in addition to that. So going through another example now, and this was a recent example. So if we go over to this area, so working our way down from the daily time frame, we can clearly see that the daily is still bearish. We had a sweep of this high followed by a daily breaker structure just here. Price has pulled back into a premium of the current daily leg, so from this low to this high, and by premium, if you're not familiar, is above a 50% of the fib retracement of that move. So between the low and the high, a premium is above the 50%, as we want to sell at the highest price possible and buy at the lowest price possible, which would be a discount. So what we can see is that price came into this area. This would be my higher time frame point of interest, and it meets all of the criteria. So we have supply / demand, we have imbalance, and we also have that it swept this liquidity to the left and had liquidity below it as well. So let's have a look what happens when price comes into that zone. We start to engineer this trend line below it. That's our inducement. We then get a break of this low. And then our higher time frame point of interest is this whole hourly zone. Changing the color of this one. So this would be the POI type 2 that I mentioned, where we have price in an uptrend, and then we get that break, retest, and then sell down. So what we simply wait for now is for price to retrace into this area and see if we can get that the lower time frame entry model that we want to see. See if price comes into that level. There we go. And it is really anywhere within this current level where we want to see price react. Like that. So what we have again, we have a sweep, followed by a break of this structure. And then the area where we want to enter from is this whole, let me just get this up, this whole 30-minute candle just here, because that is the area of supply which swept the high and broke structure within our higher time frame point of interest in line with the trend. So if we set a limit just there, stops just above, and we can target maybe just this low, or you could also target maybe like this imbalance down here, or wherever you want to target. But for me, 1 to 4, that's more than enough, so we're going to go for that. Tapped in straight away, and there we go. So these were 2 perfect examples of when the strategy works. Obviously they are cherry picked in order to show you the best examples of when this works. There will be cases when it doesn't work, obviously, as with any strategy, but through experience I found that this strategy has around, for me, obviously it also depends on how you personally view the market and how much you backtest the strategy, refine it, etc. For me, it has a 40% win rate, which sounds bad, but let me explain. If you have a 40% win rate, that is actually a very good win rate with a 1 to 4 minimum risk to reward ratio. So my risk to reward ratio is on average a 1 to 5. So if we go and do some calculations on that. So let's say 40% win rate, average 1 to 5 risk to reward. Let's say we take 100 trades. With a 40% win rate, we are expected to win 40 and lose 60. We're risking 1% per trade, so the losses would total minus 60%, and the wins would total 40. 40 times 5, because our minimum risk to reward is a 1 to 5, and that would be overall 40 times 5 is 200, take away the 60 would be 140% gain over 100 trades. And on average, I believe I take around 50 trades per year, so that means every 2 years on average it would be a 140% gain. And don't listen to anybody on social media claiming that they make 1000% every single year. If you can do 20-30% per year consistently, you are probably one of the best traders in the world that has revealed their track record. So yeah, I just wanted to show you guys that even though this only has around a 40% win rate with an average 1 to 5 risk to reward, that is in fact a very good statistic to have, despite all of the people on social media saying otherwise. They are mostly marketers, so of course they're going to say their strategy has an 80% win rate, average 1 to 10 risk to reward, all this rubbish. But anyway, I hope you guys found this video useful. If you did, make sure to drop a like, make sure to subscribe to the channel for more free content, and I will catch you guys in the next video.